In this video, I'm going to explain share dilution and stock buybacks. Hey YouTube, my name is Jeff, I'm from Finance Fit, and today we're going to be discussing a stock market term that as a novice investor, I wasn't completely all over it. And I think that quite a few people might fall into this category. We're going to be discussing stock market dilution, share dilution and share buybacks. I'll break it down for you and I'll explain what it might mean for a company and when it might be used. Guys and girls, if you like what you see today, please do us a massive favor, hit the like button, hit the subscribe button, and we'll get you guys some more content going into the future. Thank you very much. Alright, so I'd just like to start off with some stock market jargon explanations before we go a bit further. This will help us to interpret a lot more of the rest of this video. So just real quickly, we'll go through three key stock market terms and then we'll proceed further. So the first one is authorized shares. Okay, so this is the maximum amount of shares that a company can issue to the stock market. So the maximum amount of shares that a company can issue on the stock market is authorized shares. Issued shares is the total amount of shares that the company has issued on the stock market. Okay, so if the company has 5 million shares and they only issue 3 million, the amount of issued shares on the stock market is 3 million. Okay, so we're over that one. And the final one is outstanding shares. Okay, so outstanding shares is the total amount of shares that are owned by investors. Okay, so you would think that the outstanding shares and issued shares would be the same, but if a company conducts a share buyback and they buy back some of those shares from the investor, those shares become treasury shares. Okay, so treasury shares issued shares minus treasury shares become outstanding shares. Okay, so if you need to rewind the video and go over that again, please do so. Be my guest. It'll just help us to understand going further into this video. So yeah, if we're all over that, let's get started. Alright, so stock dilution, what is it? Stock dilution is just a fancy term for when a company adds more shares into the stock market. This means that the current available shares are devalued because the company profits now need to be shared amongst the current outstanding shares and any new shares that have been sold by that particular company. And although this might be true, it's always important to look into why the company took this course of action instead of being disgruntled and sharing your shares straight away, or even worse, buying the stock because you think it's on sale. You always need to make sure you understand exactly why the company took that course of action. Alright, so why might a company go ahead with a share issue? There are three main reasons why a company might go ahead with a share issue. And the first one is for capital growth. Okay, in order to do that, they need to sell more shares, raise the capital, and use that capital to invest in their company. So if your company is mainly situated in an office building or something like that, and your company starts growing, you need more people, and therefore you need more space. They might need to upgrade to a bigger work environment, so a bigger office building. And in order to do that, if they are purchasing that building, they'll need to raise the funds from the investor to raise the capital in order to purchase those buildings. And things like this, this is all part of the growth of the company. Another example is that the company might need to raise capital in order to make an acquisition. Okay, so if a company might want to buy another company, because it might be a competitor and it might be in their best interest to get that competitor off the market, or to make an acquisition of that company in order to grow their own company even bigger using that company's infrastructure. And the third reason is to make money simply just to stay afloat. Okay, this is a big red flag. If a company is just selling off shares to their investors in order to keep their head above the water, I can't see that being a good thing in any kind of scenario. It means that their business model is not working anymore, and unless they make some drastic changes, things are not going to work out for them. So you need to do a bit of research and make sure that they are making these drastic changes and trying to really change the way that they do business in order to change their cash flows and allow them to actually start making more money instead of having to raise capital through selling shares to investors, because they've only got a certain amount of shares that they can sell, and once they've sold all those shares and they don't have the money, they will go bankrupt. All right, so let's talk a little bit about share buybacks. So a share buyback is exactly what the name suggests. It's a company buying back their shares to reduce the amount of shares outstanding. And this means that the earnings per share is increased because there are less shares to share the profits with. A share buyback will normally be conducted to please investors. However, there are certain situations when a share buyback is not feasible to be conducted. Let's say a company at $10 per share has 1,000 shares outstanding. If a company at $10 per share was to conduct a share buyback of, let's say, $1,000, then they would only be able to buy back 100 shares. But if the company was to wait for a bear market or an undervaluation of their company, let's say the share price goes down to $7.50 per share, and they were then to put that $1,000 into a buyback scheme, they would now be able to buy back 133 shares. This would now reduce the outstanding shares down to 867 shares instead of a measly 900 shares from the original buyback perspective. Having less shares outstanding obviously means that the earnings per share is far greater now. So each investor that owns a slice of that company now benefits more from that share buyback. Okay, so I'd just like to go over a few little tips and tricks if you're an investor and you're looking into share dilution, what to look for and how to look for it. So what you want to look for is over a long period of time, what is the outstanding shares looking like? Okay, so go back 10 years from 2010 to now, or whatever the time might be at the time of you watching this video. Go back 10 years, have a look at the outstanding shares, see what the number is. Is the outstanding shares increasing over time, or is it decreasing over time? And if it's increasing over time, is that company growing in proportion to the amount of shares that they're selling? Or are they selling shares and still decreasing over time? Are they not growing? If they are selling shares over a long period of time, you got to make sure they have a good reason for it. Are they making these acquisitions to grow the company? And are these acquisitions helping the company? Is it hurting the company? These are all things you need to look into. But that's generally how you go about looking into share dilution. Okay, and what to look for when you're looking at companies that are buying their stocks back. Okay, so same thing, go to the outstanding shares and see if that number of outstanding shares is receding over a long period of time. And if it is, it means the company is buying back the shares. Okay, you need to look at why they're buying back the shares. Is it helping the company to buy back the shares? Are the investors happy with them buying back the shares? And most of the time the answer is yes. Most of the time, if a company is buying back shares over a long period of time, it's because they believe that their share is completely undervalued. And it's in their own best interest as well as the investor's best interest to buy back their shares at that time. Alrighty, ladies and gents, that brings us to the end of our video today. Share market dilution and share buybacks. I hope you got a bit of value out of this, and I hope you can use this information going into the future. So if you've liked what you've seen today, please do us a big favor, hit the like button, hit the subscribe button, and we'll see you going into the future. Cheers guys, bye.